Hey Bowtie Nation, Joseph Hogue here in the middle of a once-in-a-lifetime opportunity for investors. The recent stock sell-off and AI bubble fears that I'm about to prove are your opportunity for 2026 returns. We hit our sell-off target of 5% lower on the S&P 500 last week and rebounded within a percent of the all-time highs. But those AI bubbles are back for another opportunity to buy. Feeding the fear are the short sellers Chanos and Michael Burry. Chanos is calling out debt borrowed by data center and AI cloud companies, and Burry is saying that companies are using accounting tricks to hide the coming crash. I'll detail both of those warnings and how they are right, but too early in a minute, and then prove that the market isn't going to crash anytime soon, and the stocks you need to be buying instead. Nation, understand that in stock investing, being early to the party is just as bad as being wrong. Michael Burry is the guy that shows up at your house party while you're still shaving. You're like, hey, Mike, the invitation said 9, but no, 5 o'clock is fine. Come on in, make yourself at home. Burry is famous for calling the housing market bubble, but what most people don't remember, he was calling it a bubble in 2004, 4 years too early. Looking through annual letters to his Scion Capital Fund, he was warning of a financial bubble by October 2004 and again in early 2005. Then, by March of 2005, he was warning of the most significant credit bubble history has ever seen. So he's here in early 2005 shorting the market, and if you go back and just watch the movie or even read the book, he almost bankrupted his company, his hedge fund, because he was just way too early. He only avoided the worst because he stopped returning investors' money when they asked for it. But then looking at this chart, selling out early in 2005, you would have missed out on 40% upside and almost 3 years of a bull market. In fact, what happens to most investors? They sell out on these doomsday stock market crash warnings. Then they sit there watching the market boom higher, only to give up and buy back in right before the real crash. Nation, predicting the end of the world is no good unless you can put a date on it, and I'm about to put a date on the AI stock bubble. I'll show you the earliest the bubble is going to pop, why you want to load up on stocks right now, and the 7 stocks I'm buying. I called out the fake crash on November 17th and why this market sell-off is nothing more than a 5 to 15% correction we see almost every year. You can see here in this chart of annual stock returns, the red dot is the lowest stocks go each year, and you see almost every single year we see a sell-off of around 10% where investors get skittish and rush to sell. It happens almost without fail and sometimes more than once a year, but those green bars, those are the year's official return, and you see, it's positive most years. In 37 of the last 45 years, stocks in the S&P 500 had produced a positive return, meaning that taking advantage of those sell-offs made you a lot of money. I'll link to that warning video on the fake crash in the description. Check that out for more detail on why these corrections happen, how to spot them, and when to know a crash is coming. But Chanos and Burry are still beating their drum on this bubble, mostly because they're heavily shorting AI stocks and losing a lot of money every day the bubble doesn't pop. The thing is though, like Burry on the housing bubble, they are right that debt and this depreciation schedules will be factors when that AI bubble does burst. They're just wildly off on the timeline, so I want to take you through both of these arguments, put it all together with my research, and prove that we have at least another 12 to 18 months to invest in this AI bull market. Now I'm going to have to go all markets nerd on you, and this is going to get technical, but you need to understand it so you don't get freaked out when these short sellers keep going on CNBC to preach their gloom and doom. Chanos' argument here rests on obsolescence of chips and the loans taken out on them. The idea here is that data centers, especially the barely profitable leasing companies like CoreWeave and Nebius, are buying billions of dollars in NVIDIA chips. They don't have the money, but are using those chips as collateral on loans. The idea is that as that AI boom keeps growing and they lease out those data centers to Amazon, Meta platforms, and pretty much everyone, then that money comes in to pay for the loans. Chanos points this out with businesses like the NeoCloud. So those are the data center cloud services providers like Nebius, like CoreWeave that are filling up, building those data centers and then leasing those services out. A lot of those AI companies themselves are just loss-making enterprises right now. He goes on to say the financing trend here, pioneered by CoreWeave again, is a form of asset-based lending. Those money-losing companies are using their assets, so those chips, those semiconductors that they own, they bought from NVIDIA, as collateral to secure the capital that they wouldn't otherwise be able to access or at typically higher interest rates. The article points out that NVIDIA backed CoreWeave, which went public just earlier this year, and its rival provider FluidStack each have about $10 billion in debts using those stores of GPUs, those GPUs they bought from NVIDIA as collateral. And what Chanos is saying is that the revenue for this isn't going to come fast enough. The chips aren't going to be worth nearly as much as the loans, and everything is just going to go to shit when that newer, faster chips come out. That's because just like when a newer version of a car comes out, the previous year's versions just aren't worth as much on the resale market. If you can afford a Lambo, why buy the old clunker when you can get this year's new model? And this is where we get into that idea of depreciation. What happens when those newer, faster AI chips come out? Nobody wants the old chips that CoreWeave, Nebius, and everyone has paid hundreds of billions of dollars for. The price for those chips craters. Worse still, though, the data centers that either have to pay hundreds of billions more for new chips, or they just can't get the leasing contracts, which means less revenue and defaulting on those loans. For his part, Michael Burry is saying essentially the same thing, but using accounting rules to show it. Rules allow companies to depreciate their capital spending over years. Say you buy $100 million on NVIDIA AI chips. That's an expense that reduces your profits, but you're going to use those chips over 5 or 6 years. So you spread out that cost. You depreciate the asset on your balance sheet. And over time, taking just 1/6 of that, or about $17 million in expenses each year. That less expense means your profits are higher. But Burry is arguing, like Chanos, that those data center AI chips won't last 6 years. Nobody is going to want them after just a few chips and when the new chips come out. If that's true, and your company has to spend another $100 million on new chips maybe every 3 years, your profits were much lower in the past and in the future than investors thought. Burry points out a critical contradiction in what NVIDIA is saying about its chips here. NVIDIA says the newest chips are superior in performance, efficiency, and capability, but at the same time, it promises that the older chips will remain economically viable, or with higher prices. One of these defenses, they say, has to give. And both Chanos and Burry have valid points here, and since NVIDIA is the chip maker for the AI boom, we can look to its upgrade cycle and past sales to put an expiration date on the AI bubble. We can see here in the income statement for NVIDIA, revenue was basically flat through 2023, but then more than doubled into 2024 on that AI boom and the demand for GPU chips. Now these were the Hopper architecture, the H200 chips used in gaming. Then, over the past year, the Blackwell architecture chips came out and sales went through the roof, up 3x from 2024. So over the last year is that big wave of chips used in AI. Next, we need to look for the timeline of new architecture, new chips by NVIDIA. And in fact, we can see in this article by The Verge, it says NVIDIA now makes over $2,300 in profit every single second. It's on the back of that AI revolution where it just dominates in those chips. NVIDIA is right now rolling out its Blackwell Ultra line, but it's not that big step change that's going to make those older chips obsolete. It's a lot of the same performance metrics. Next, though, is the Vera architecture, which is supposed to double that performance. Here we can see it says whose full rack should offer 3.3 times the performance of comparable Blackwell Ultra 1. NVIDIA is promoting the Vera release for late 2026, but just like we saw with Blackwell, there is a good chance it will be late, and there won't be enough produced to meet that demand. There is going to be a long backlog of orders here, so most of the data centers will continue to use those Blackwell chips well into 2027, supporting the price for the resale market. And that means 2027 is probably the earliest we start to see those Blackwell chips depreciate in value, the trigger that Chanos and Burry are calling for the popping of the AI bubble. But then even that might be too early. We've already seen trillions of dollars plus committed to building out AI data centers and everything that goes into them, the hardware, the networking. Because those data centers can take 2 to 3 years to build, the market won't be expecting that much of a return for much of that time. Meanwhile, we're going to continue to see more AI spending, and the stocks that I'm going to show you next are going to continue to benefit. I'm going to highlight the 7 stocks I'm buying on the continued AI bull market, but I'll also post in the description a full analysis of all 65 AI stocks, including revenue growth and valuations. It is a complete list that I use to find the best deals in AI stocks, and some of these are even a better buy with the recent sell-off, so check out that video next. And what might save us from that AI bubble popping even in 2027 is if those use cases continue to boom. BNY Mellon is using over 100 AI agents to touch everything that happens at the bank. Walmart is aggressively using AI of sourcing products to design and customer marketing. It's already reduced the time to produce a collection of clothing from 6 months down to just 4 months. So, what happens is if those use cases continue to come out, if revenue generation on AI lives up to those early expectations, companies start seeing some kind of return on the spending for those chips is going to continue. Chips may depreciate in value a little, but as long as that spending is there, those new loans are going to be made and the more data centers will be built. That could extend the life of that AI stock bubble for years, but either way, we're still looking at least another year or more for buying opportunity. Looking for these top AI stocks, I want to revisit the AI supply chain, find where the bottlenecks are in shortage and which stocks are going to benefit. Here first, we see in accelerators and the memory companies, huge demand for those accelerators like Marvell Technologies, like Broadcom, ticker AVGO, as well as the memory companies. Memory is in huge short supply here, so we want to look at these memory companies. The one thing you want to distinguish here between some of these makers in the AI supply chain is if they are also in consumer electronics. It could hurt them, and I'm going to explain why. Companies like Samsung, like Dell, that have a piece of this AI supply chain are doing well on that AI supply. But the problem is a lot of the components that go into that AI supply, especially the memory, the prices are rising so much in these because there is so much shortage for those memory components that makers are prioritizing the AI supply. So they're putting that memory into the AI supply chain rather than consumer electronics. That is making consumer electronics much more expensive. So I think what we're going to see is while these companies like Samsung, like Dell, that are in the AI supply chain with memory, with servers, they're going to do well on that part of their business. They are going to struggle with their consumer electronics side of the business, okay? Because the profit margins are going to go way down on those as those consumer electronics and the components that go into them go way up. Those margins, that profitability is going to hurt those consumer electronic companies. So I want you to look for the companies that don't necessarily have much of a consumer electronics business and are more focused on the AI supply chain. Companies like Micron and like Marvell here in the accelerators and the memory companies segment of the supply chain. We can see here Marvell Technologies, ticker MRVL, actually down 3% over the last year. 5 years, it's still doing very well, up 100% over the last 5 years. For each of these, I want to check out the growth as well as the valuation on those, get you started on some of that basic research that we do here on the channel. So if we go to the analysis tab here for Marvell Technologies, we can see that it is expected to post 41% revenue growth this year. That is very strong revenue growth. Really, anything over 20% is very strong revenue growth for a company. We also want to look at the estimates for the earnings per share. This has a lot to do with those margins, with the profitability in these companies. We can see it expected to post $2.80 in earnings per share this year against $1.57 next year. 338 over the next year, or I'm sorry, $1.57 last year. So we do see a rising trend in earnings per share. That tells me that Marvell is being able to get good pricing out of its products and is not seeing its costs just overrun and seeing its profitability hurt. Here in the valuation metrics, we'll mainly be looking at the price to sales ratio. Okay, so this is the price investors are paying for every dollar in sales. Okay, you can find it by the market cap. So the market cap is the value of all the shares in the market, value of the company basically, right? $78.5 billion divided by the sales made over the last 12 months. Okay, so this is a trailing price to sales basis. How many dollars are investors paying for every dollar in sales generated by the company? Here we can see for Marvell Technologies, it's almost 11. It's 10.95, okay? Now, what we don't know is if that's a good deal or a bad deal. We can look to the history here. We can see that in the past, investors have been willing to pay as much as $18 per every dollar in sales. So that would say that this $11 per dollar in sales is cheap and it's a good deal. But we can also see that investors have soured on the stock at times and only wanted to pay about 8.8 times. Okay, so neither expensive nor cheap here on that 10.95 times price to sales. What we have to do, we have to compare it with other stocks to see which one is the better deal. But 10.95 compared to a lot of AI stocks, not too bad of pricing valuation here for Marvell Technologies. We can see here Micron Technology, ticker MU, in that memory component of the AI supply chain, up 144% over the last year, and a lot of that just recently, that memory side of the AI supply chain, really the main focus for shortages right now. So it keeps on building. Again, a lot of it is to do with reprioritizing that from consumer electronics into AI supply where it can be sold for more expensive. So Micron technology doing very well on that theme. And we see that trend here in the growth, expected to grow sales by 47% this year to $55 billion. A little bit slower, 15% next year. I think it outdoes that. If the AI spending theme continues, it is going to do much better than 15% growth next year. But we see the real progress here in the earnings. Almost double last year's earnings, more than double last year's earnings, now to $16.90 in earnings per share expected this year, up to $19 next year. So we do see, again, here in Micron technology, we see very strong micro fundamentals here, where it is able to increase the price of its products. It is not seeing its own costs balloon higher, and it is growing that earnings per share. Next here in the AI supply chain, we have the GPUs and the CPUs, the semiconductor chips, the main focus of the AI spending theme so far over the last year. We have NVIDIA and we have AMD, really NVIDIA, the core supplier of those chips to the AI spending theme, but AMD catching up very quickly. I started recommending shares of AMD here in January and February of this year, around $108 per share. That's my cost basis, is now up $224, up 57% so far this year. And really on the idea that it can take some market share from NVIDIA. Obviously, NVIDIA still has far and away the better performance in its chips, but AMD is capturing some of that market, especially the inference market. Understand there are two sides of AI. One, you have to train your models, your AI models. Those companies, they need a tremendous compute power. They need a tremendous amount of chip performance for training. But then once you shift to inference, to actually using those models for customer cases, you don't need that kind of power anymore. So a lot of companies, they are now shifting some of their chip spend into that inference side of the market. And they're finding that Advanced Micro Devices, ticker AMD, sells just exactly the kind of chips they need at the right price. That was backed up with the company's Analyst Day presentation just recently. CEO Lisa Su talking up 35% revenue growth for years to come. Here we can see the analyst, 46 analysts covering shares of AMD, have price or revenue growth targets of 31% this year and next. $34 billion in sales this year, up to $44.5 billion next year. That is tremendous growth at that scale. On the price to sales here, 11 times on a price to sales basis. And you can see it has traded much more cheaply in the past. Back there in March of this year, when I was first started recommending the stock, down as far as 6.5 times on a price to sale. Investors were only paying $6.50 per share for every dollar of sales generated by the company. Now they're having to pay $11 for that. That is a much higher, so it is much more expensive now, but I think still a good deal, especially when we compare it to NVIDIA's price to sales valuation, NVIDIA's expense there. AMD continues to take that market share, and with that 31% sales growth every year, you're going to see this stock go much higher, $223, $224 per share. It's going to be a very good price when we see that 31% sales growth this year and next. Then the king of AI, NVIDIA Corporation, ticker NVDA, up 37% this year. Obviously, if we go out further there, 5-year chart, 1,200%. But this year has slowed down a little bit on those returns. In fact, lower than those returns on AMD. AMD starting to catch up with its chips, with that market share, and showing in the stock price of 57% this year for AMD, 37% for NVIDIA. Still a great return on shares of NVIDIA. And we do see that faster upgrade cycle here in its revenue, 63% revenue growth expected this year to $213 billion, 48% next year. So even though the shares have not kept up quite with AMD this year, the revenue growth much faster and should continue to dominate this theme. NVIDIA shares are cheaper here on a price to sales to growth ratio that I'm going to show you here in a bit. But also looking at these earnings per share from $3 to $4.70 this year, almost to $7.50 next year. So still doing very well. NVIDIA is able to command the kind of price it wants for its chips because they are in such high demand. Looking at the price to sales valuation here, like I was talking about with AMD, a little bit higher than it's been in the past at 11 times price to sales for shares of AMD, but compared to NVIDIA, it's still relatively cheap. Here, NVIDIA trading for 23 times on a price to sales basis. Now, if we go back in history on NVIDIA, we can see that investors were actually willing to pay much more in the past, 34 times, 26 times, 30 times price to sales. So what we can say here is in shares of NVIDIA, relatively cheap compared to a lot of its past multiples here, other than here in April, 20 times price to sales, but relatively cheap compared to the past. And with that growth, I think with that growth, it makes these shares still attractive, even on that higher price to sales ratio. So not necessarily that you have to own just one chip maker, AMD or NVIDIA. I think you own both of these, you own shares in both of these, and ride that AI theme higher. Going back to that AI supply chain, and my favorite stock in this theme by far, here in the server manufacturers. So again, folks, if you understand how a data center works, you have you have all these chips that really are the neurons that the processing power for these AI operations from NVIDIA, from AMD. Those chips have to go into servers. Okay, those servers can hold thousands of chips within them, putting all that performance, all that compute power together to actually be the brain of the data center. Here you have companies like Lenovo, you've got Dell, you've got Hewlett Packard Enterprise, and you've got my favorite Super Microcomputer, ticker SMCI. Now, I have talked about Dell and Hewlett Packard Enterprise, HPE, in the past. Of the two, I do still like HPE. It's got a little bit more of the data center and enterprise focus. Dell, like I was talking about earlier, is just too much in consumer electronics. So they are seeing their costs for consumer electronics, for laptops, just skyrocket off of this demand for memory chips and other supplies that can also go inside these data centers. Okay, so they are having to run into bottlenecks, supply bottlenecks for their consumer electronics components. That's seeing the price of those go up and the profitability really come down on Dell. So I want to stick with either Super Microcomputer or Hewlett Packard Enterprise, and I like Super Microcomputer much better here. Here we can see shares of SMCI up 11% year to date, but this is a roller coaster, folks. In fact, as much as I like some of these stocks, as much money as I think you can make here on shares of SMCI, on Super Microcomputer, and as much as I have in the stock myself, over $1 million in the shares of this company alone, if you cannot handle that risk, if you cannot handle that up and down roller coaster of this stock, even more so than the up and down roller coaster that you get from most other stocks, you cannot invest in this company, okay? Because what's going to happen is you're going to love yourself when it's up here at $45, $50, even $60 per share. But then when it starts falling to $40, even into the 30s, you're going to get scared, you're going to get stressed out, and you're going to sell at exactly the wrong time, okay? You want to be able to wait these out. You want to be able to not get stressed out, not lose sleep, and wait this one out until it gets back into $45, $50, $60 per share. Here in the forecast for SMCI, we start to see why this is my favorite AI stock. Okay, growth, 65% expected to $36 billion for this year's sales, up to $36.2 billion for sales. That was just reaffirmed by the company over the last earnings report. So this is still very much on the table. The 65% sales growth to $36 billion, up to $44 billion and 22% next year. Again, like a lot of these, I think that future growth is upgraded and is higher, maybe as high as $45, $50 billion next year as this AI theme just really keeps on going. But one thing that's why the shares have sold off so much in the past month here is if you look at the earnings per share here, average estimate for earnings per share this year, $2.06, the exact same as they reported last year. Okay, so what we're seeing in the server space is so much competition, so much kind of a pricing war on servers in the AI market that they're really spending so much on research and development, so much on marketing, so much on other costs that they're eating away all their profits. Now, the upside to this is going to be what we're going to look at in valuation next, but also in the next year estimates. 50% earnings growth expected over the next year to $3 per share. That makes this a steal at this price at $34 per share. Then if we look at the valuation statistics here, remember, this was a company that expected to book 65% revenue growth, 50% earnings growth over the next year, now trading at just 1 times price to sales. Okay, think back all the other companies we talked about, 23 times price to sales, 20 times price to sales, even 11 times price to sales was cheap among some of those companies. 1 times price to sales. You are paying $1 for every dollar in sales generated by this company. Okay, you can see here in the past, that is basically the lowest it's been. When I started recommending buying the shares at $18 per share last year, it was right around 0.6, 0.7 times price to sales. So cheaper then, but still over the past, in fact, over the past year and a half, it's traded as high as 4 times, as high as 6 times price to sales. Okay, so investors have been willing to pay 6 times more for every dollar per sale as they are right now. That shows you the kind of fear in this stock right now, that investors are just confused. They don't know what they're looking at, and they're selling out of this stock. You can get these shares for $1 for every dollar in sales generated by the company. That is a steal. If those sales do go up to 65% this year, the 22% next year to $44 billion, look at what that does to the valuation of the stock. Now, what you want to do, when you're looking at these to see kind of a forecasted price for these, if we take this, say 1.4 times price to sales, okay, even 1.2, let's take 1.3, okay? Investors have been willing to pay 1.3 times or more for this stock, times its sales, many times for very much most of the last 2 years, okay? So if we take 1.3 times price to sales times the $44 billion in sales expected next year, that gives us a price or a market cap of this stock of $57 billion. Divide by the $20.2 billion it's sitting at right now. That is a 183% return. Okay, that is a price of $96 per share. A price of $96 per share forecasted over the next year for Supermicro computer. And I think it goes even higher than that. Not on that AI supply chain chart that we looked at is another major bottleneck, another major shortage in the AI theme, in that supply chain, that of networking capacity. Okay, so here Wall Street Journal article points out that the just greater use of artificial intelligence, the chatbots, the agents, is going to stress the country's existing networking capacity. Okay, networking hardware, the software within those data centers. That is what moves the data from the memory, from the storage, to those processors, to the GPUs, to the servers, processes that data. So the networking, that is like the highways that moves the data back and forth there. The article here points out $34.6 billion global data center networking market forecast to reach $120 billion by 2033, according to market research firm Straits Research. That is, sales of data center switches, which route that traffic, could nearly double over the next few years. Sales of backend switches, which connect the AI chips, could quadruple. Within that, we find another one of my favorite AI-themed stocks here, Broadcom Inc., ticker AVGO. I don't think any other company besides maybe NVIDIA touches as many points within the data center as Broadcom. We did see it there in the AI supply chain, in the accelerators getting the most out of the chips, but where Broadcom really is has that competitive advantage is in its networking hardware and software. We can see up 67% this year. Growth not quite as fast as we saw in some of those other stocks, 22% growth expected this year, but then 35%. So even faster growth as it works through some of the bottlenecks, some of the shortages in its own products that it can feed into data centers. $63 billion this year, $86 billion in sales expected next year. And here again, we see very profitable. This company is able to command the price it wants for its products because of that shortage in them, from $4.87 to $6.74 in earnings per share expected this year, up to over $9 per share next year. Here in the valuation, though, we see the most expensive stock in the 7 stocks in the AI theme here, 31 times price to sales. And we can see it is much more expensive than investors have been willing to pay in the past. So while I do really like shares of Broadcom, ticker AVGO here, I think it is very much more expensive than a lot of these other stocks. It's more expensive than it has been in the past. So this is probably the one that I would wait for a better price to come down on. Also in that networking theme, though, Arista Networks, ticker ANET, up only 16% over the past year, but really a strong contender in that data center networking theme. You see here even stronger growth this year than Broadcom, 27% revenue growth, a little bit slower next year, 22%, but I think they upgrade that. I think it does better than that $10.9 billion in sales next year. But then if we balance that on the valuation, 19.7 times price to sales, so more expensive than some of these other stocks that we've looked at, certainly more expensive than shares of SMCI, but still much cheaper than Broadcom, that AVGO. So $19.76 for every dollar in sales. The valuation here, it has been higher in the past, 23 times there, 21 times, but it has also been lower, 14 times, 19 times price to sales. So this one isn't necessarily expensive or cheap compared to its own history. Click on the video to the right to see that complete analysis for every AI stock, along with the growth rates and the best buys for your money. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.